This is a lecture from OpenTuition. To benefit from the lecture, you should download the free lecture notes from opentuition.com.
Well, in our previous session together, we saw how it was that the assessable benefit in relation to the provision of a company car by an employer would be computed so far as each tax year is concerned. Now, that benefit was not just, the assessable benefit was not just for the actual provision of the car itself. That would cover all other costs other than fuel to do with the car. So, for example, there may be the maintenance costs that are run, repairs there, new tyres, new brakes, whatever it might be. Any of those costs incurred by the employer, those are covered within the basic car benefit itself. The only additional expense that will require a separate and an additional benefit to be determined is this one, where fuel, either diesel or petrol of course, is provided for the private use of the employee. So, what have we got? As we have just said, the car benefit also covers the running costs of the car, but does not take account of the fuel provided for private use. So, if any amount of the private fuel cost, any amount of the private fuel cost is paid for by the employer, then there will be a fuel benefit. Now again, this fuel benefit will be an annual figure. So if you've not had fuel paid for the entire tax year, then it will be time apportioned accordingly. Now the amount of fuel benefit is actually very, very easy to compute off the back of what we have already done in determining the car benefit itself. It is computed on a base figure of £22,600. That figure will be provided to you again on your rates and allowances page, multiplied by the percentage used for calculating the car benefit. So once you've got that percentage for the car benefit, remember that we applied to the list price of the car to determine the benefit of the car. We also then pick up that percentage and apply it to £22,600. Easy. We don't have any other figures to worry about. Pick up the percentage from your car benefit calculation and apply it to the £22,600. Now, just a few things to be careful of. The fuel scale charge would be reduced if, for example, you only got the car given part way through the year, or not it's likely to be that they withdrew that particular fuel benefit. They stopped buying your private fuel, you had to pay it all for yourself partway through the year there. Just remember, again, like we'll see with, if you remember our first example, Lewis, in terms of car benefits, the car was only provided partway through the year, so that's when you will do your time apportionment. One other important difference, when we dealt with a car benefit, we also said that if the employee made a contribution back to the employer for the benefit of the use of the car, then that would be an allowable deduction against the car benefit there. And we saw that in one of our heroes drivers there in that previous session. That does not apply when we talk about the fuel benefit. Here it is an all or nothing. No reduction is made if the employee contributes, now watch out for this word, towards the cost of petrol for private use. But if he pays for all fuel used for private motoring, the charge is cancelled. There is no fuel benefit. So very simple. If the company pays for all of the fuel costs to begin with, but then the employee were to reimburse the employer for all of his private fuel, that would mean that the company is no longer paying for any of his private fuel and there would be no fuel benefit. It's all or nothing. But if the employer is left paying for any part of the private fuel, then there is a full fuel benefit. We never deduct employee contributions from the fuel benefit. We determine from the amount of employee contribution made whether or not there will be a fuel benefit. This is the essential difference. Right, example 5. using the information we had from before with all our list of marvellous drivers there, Luis, Nico, Fernando, Jensen and Sebastian, assuming also now that Fernando pays Speed Merchants plc £600 during 1718. Remember this from the example 4. But towards the cost of private fuel. Towards the cost of private fuel. Although the actual cost of this fuel was £1,000. Now, as soon as you see that, you know that basically the employee contribution is irrelevant, because he's only making a contribution towards the cost of the private fuel. It still leaves, as you can see here, a shortfall. He's contributing 600 towards what was an overall private fuel cost of 1,000. It means that the employer is still left paying for some part of that private fuel. Therefore, there will be a full fuel benefit. More of that to discuss when we come to dealing with younger Fernando there indeed. So, calculate the fuel benefit for Luis, Nico, Fernando, Jensen, Sebastian. Right. We need to go back and have a little look at what we found, of course, when dealing with those percentages. Now, if you look back to the figures that we got in relation to each of these, now, I don't know whether we've still got them there, hopefully. We have got in relation to Luis, it looks like 26%, but that was only for 8 months. In relation to Nico here, we have got 36%, and that was a provision of the benefit for the full year. We'll assume again here that that provision is now for the full year. So far as Fernando was concerned, maximum 37%, and we're now also told about this contribution that the employee Fernando has made towards the private fuel cost incurred by the company. Jensen, what we saw was he got 90 grams per kilometre, and therefore we looked at the level that that gave us, and that I seem to recall I think was 17%, but we'll check on that one. You just check back and see what you've got as well. And then finally for Sebastian, 16%, again as he got a low level of grams per kilometre of CO2 emissions. So using those figures now, let's do Lewis, is the most interesting one here. Using those figures, now working out the fuel benefit. Firstly for Lewis, the first figure you will use, and this will be applicable for every one of these employees, is the £22,600 fuel benefit. That's the figure that we will use, provided to you, of course, by the examiner on the rates and allowances page. That's the figure to which you will apply your percentage figure. So far as Lewis was concerned, it was 26%. But Lewis has only had the use of the car for some 8 months of the year, and with it, therefore, as this fuel benefit is also an annual benefit, we time a portion. Nico, as with all of them, 22,600. This time, what was his percentage? 36%. And obviously, each of these you work through. Fernando, we've already seen what the issue is with Fernando. Again, though, our 22,600 standard charge there. 22,600 times what was his percentage? 37%. And the fact that Fernando has made a contribution towards his private fuel is irrelevant. There is still a full fuel benefit. Now then, the difference in contributions, there was £1,000 full fuel cost, and I think his contribution towards that was 600. Had he paid an extra £400, therefore the full £1,000 had been reimbursed back to the employer, that would have meant that there was no fuel benefit. Now look at what this assessment is going to cost Fernando. 22,600 times 37%. Now then, if my calculations on that are correct, that comes to a figure of £8,362. That is an assessment. That is a part of his employment income assessment overall. That is a very big number. So because of that inclusion of this fuel benefit assessment going in as part of his employment income, there's a very good chance here that Fernando will be a higher rate taxpayer. And as a higher rate taxpayer, that's an extra £8,362 of taxable income to be taxed at, if he is higher rate, 40%. Now, 40% of 8,362. That is going to be significantly over £3,000. 40% of £8,000 would be 3,200. And we got another 362 at 40% on that. That is a lot of tax. Well over £3,200 worth of tax. You can work the precise figure you wish. Now then, is this a very sensible arrangement that we have at the moment? Because here, as we've said, that the employer is paying now for just £400 worth of his private fuel. Fernando is ending up paying HMRC well over £3,200. This is a very silly situation. So what would it be advisable for Fernando to do if this is the situation he finds himself in at the end of the tax year? He's worked out that he's made a contribution, we'll know what that is, £600, but based on the mileage, what was business, what was total, what was private, £1,000 is the full private fuel cost. Then, far better that Fernando does what? Fernando should now, of course, further repay to our Speed Merchants PLC, the company there, repay at least £400 to the employer. And what would that mean? Equals no assessable benefit. That therefore goes away. And for the sake of paying the employer a further £400, we're saving over £3,200 worth of tax. Now again, no doubt nobody wants to pay £400 over to their employer, but far better to do that than to end up paying HMRC well over £3,200. Again there, that's the figure we need to be paying. So our advice to Fernando, make that further repayment of £400 to the employer, and then you lose the assessable benefit, the fuel benefit. There will be no such benefit. Jensen, again, 22,600. His figure was 17%. Work it through. Again, you'll see here that it makes no difference whether the car is petrol or whether it is fuel. That dictated the original percentage figure that we are using here. It has no further impact. It is that percentage times whatever it is for that year, the assessable fuel benefit. And that's £22,600 as your benchmark figure. Sebastian, so young Seb here, what do we do for him? 22,600, and his percentage, I think, was 16%. Work them through, check it out with the answer in the back, please. But again, the fuel benefit, assuming that we've got our list, that we've got our CO2 emissions percentage correct from calculating the car benefit, it's a very quick and easy add-on for you to work through. Okay, we're getting there now, not much more to do. On to the final set of benefits here. We stay with vehicles for just a short while, and now we don't have a company car, we have the luxury of a company van. Yeah, you've made it now, you have a company van. Or indeed, not that it's very likely, a heavier commercial vehicle, but a van. So where an employee uses an employer's van for journeys between home and work, and other private uses insignificant, the question would make it very clear, therefore, that that was the case. Then there is no benefit. Now, if you are using your company car for journeys between home and work, that is private use. So this too would be classified as private use. However, if it's the van that we are using to go to and from work, and only insignificant further private use on top of that, it's ignored. And on that basis, there is no benefit in relation to the van. But where the private use of the van is not classified as insignificant, then it's a standard tax charge, £3,230 per annum. Again, time apportioned if you've not had the use of the company van for the entire tax year. Additional charge would then be made for fuel provided for unrestricted private use. Again, only if we've got this unrestricted private use there, equal to £610 per annum. Now, they're not the hugest figures in the world, but obviously if it could be avoided, it would seem a good thing so to do. And that's down to whether or not private use is insignificant or not insignificant. These benefits, whether for the van itself or whether in relation to the fuel provided, both benefits, of course, as ever, time apportioned if the van is unavailable to the employee, like with the cars, for 30 days or more during any part of the tax year. Usually because either only part way through the year did you get the use of the car, or maybe you left that employment and therefore it was withdrawn from the point you ceased that employment. You time apportion. It's an annual benefit that we've got. Maybe rather more likely for exam question rather than vans, though it does come up. Oh, one other thing, I'm afraid. Those things have to be learned. That 3230, that 610, not unfortunately provided on your rates and allowances page. Those you will need to know. Don't bother about learning them now. Make that closer to exam date, of course. Then beneficial loans. What do we mean by a beneficial loan? Well, here we're saying another way by which a benefit may be provided by the employer to the employee is to provide them with a loan at a beneficial rate of interest. A beneficial loan, therefore, one made to the employee by the employer below the official rate of interest, which for our tax year is 2.5%. The benefit to be computed is the interest on the loan at the official rate, 2.5%, of course, less any interest, if there is any, that is actually paid by the employee. Quite frequently, it's just an interest-free loan provided by the employer to the employee, so it's a straight 2.5% on the outstanding loan. Before we go ahead and do such a calculation, there will be, in fact, no benefit if the loans do not exceed £10,000 in total at any time in the tax year. So if loans taken from the employer by the employee or added together, should there be more than one, if they have not exceeded £10,000 at any time in the tax year, then there's no benefit to compute. Now, of course, the chances are an exam question they want you to calculate this figure, so there will be some point at any time in the tax year. If it has exceeded 10,000, then there is a benefit to be computed. Again, what we will be computing will be an annual benefit. Intriguingly, however, we then see that there are two methods that we may use to compute the benefit. That being, at always our starting point, the average method, before then looking at the so-called, what can be called different things, accurate method, strict method. These are all names for one and the same thing. But here is our first port of call, the average method there. Now that's very simple because it's acknowledging the fact that though there may be a loan outstanding during the tax year, it is very probable that the employee will be making repayments of that loan through the tax year. And the most usual way by which repayments are made back to the employer is through a salary deduction. So every month, therefore, coming out of your salary, there is an amount taken for the loan repayment. So, for example, you might have borrowed £20,000, nice employer, £20,000 from the employer, and you are required to pay that back at a rate of £500 per month. So over the year, 12 times 500, £6,000 there will be repaid. Now that £500 a month will come out month by salary deduction. Your employer will deduct it at source. They'll take it out of your pay. They get it before you get your hands on it. This will, of course, be a deal that you, the employee, have agreed to. In which case, here, even though there is another method, the strict or actual, you will use the average method. Because what it does is this. We base the benefit not on a different amount each month, because it's going down the loan by £500 a month, but we use the loan outstanding at the beginning and the end of the tax year. So, if the loan outstanding at the beginning of the year was £20,000, we repay at £500 per month. That therefore will mean at the end of the year, the balance will be 12 times 500 is 6,000, I think. Take that away from 20, it's 14,000 at the end of the year. Add them together and divide by 2 to get our simple average of the average loan outstanding for the year. 20 plus 14 is 34, divide by 2. So that's a £17,000 average loan outstanding for the year. We would then multiply that by 2.5% and deduct from it any interest actually paid. What we will probably more see, though, in an exam question is the less likely practical scenario where the loan is actually not being repaid on a steady monthly basis, such as we see there, but there will be individual ad hoc repayments of parts of the loan. And that is more likely where the accurate method comes in. So what we might have had is £20,000 at the start of the month. At the start of the tax year. So that would be at the 6th of April 17. But then there was a repayment on, say, let's make it nice and easy, the 1st of October 17. And the repayment was, let's say that's £6,000. Bringing the loan down to £14,000. And that was still the case at the 5th of April 18. It's still £14,000. So what we've now got on an accurate basis, it calculates the benefit day by day on the balance actually outstanding, although in practice, on a day-by-day basis, we of course do our apportionments to the nearest month. So either the taxpayer or HMRC can decide to use the accurate method. Now again, if this, for example, was an interest-free loan, the strict method there would have given you £17,000 at 2.5%. What we do now on the accurate method, it should come out in fact at the same figure here, you'd have £20,000 at 2.5% for 6 months. Oops. And you'd have £14,000 at 2.5% for, again, 6 months. Now, the reason why we have the ability to have the accurate method, either for the taxpayer or HMRC, imagine that what had happened here is that the repayment of £6,000 did not, in fact, occur on the 1st of October, but was sustained later in the tax year. For example, it was on the 1st of March 18. So imagine now we had a loan at the 6th of April 17 of £20,000, and it stayed that way until we got to the 1st of March 18, when the loan went down to £14,000. Now then, on the average basis, we got £17,000 times 2.5%. On the strict basis, we'd have £20,000 for 11 months times 2.5%, and we'd have £14,000 for 1 month, only there from 1st of March to the end of the tax year 18, 1 month. times 2.5%. Now, I think you can see there that the weighting is heavily in favour of the £20,000. So HMRC in that situation would be able to opt for the accurate method, because that would therefore increase the assessable benefit. If, of course, the repayment had occurred not in the second half, towards the end of the tax year, but had occurred towards the start of the tax year, then the balance would be the other way. So instead of 11 months, had it been the 1st of May of 17, for example, when the repayment was made, there would only be 1 month at 20,000, and the 14,000 would then be 11 months. Clearly, that is going to be lower than 17,000 at 2.5%. So we would have to therefore do the strict or accurate method at the behest of the employee. So where the accurate method would give a lower assessment, the employee will ask for the accurate method to apply. Where it would give a higher figure, then HMRC would be eligible to be able to claim the accurate method. If, of course, there was very little between them, then it's perfectly possible that the HMRC will not bother. But in an exam, we've got to do the strict method again and do it on that actual basis and presume that if the employee adopts it, it will be used, it'll be the lower figure. If the repayments are in the second half of the tax year, therefore there's a bigger amount outstanding for more than half of the year, then HMRC would adopt that method. Okay, that's the basic principle. You've got example 6 here to have a go at. Calculate the taxable benefit for 2017-18 under the average method and under the accurate method there. Now, just have a little read for you to be able to glean what is going on and establish what that would be. Right. Jack was given a loan of £35,000 by his employer on the 31st of March 17. What does that mean? It means at the start of the 17-18 tax year, the outstanding loan is £35,000. This time, instead of being interest-free, this is just going to make the calculations more difficult, but the principles stay the same. Interest is payable on the loan at 1% per annum. And on the 1st of June 17, Jack repaid £5,000, and on the 1st of December 17, a further £15,000. The remaining £15,000, let's just check that. So he repaid £5,000 in December, £15,000 in December. That therefore, June was 5,000, December was 15. That's 20,000 repaid. Yeah, the remaining figure with 15,000 still outstanding at the 5th of April 18. Jack earns £30,000 per annum. That's just telling you what level of taxpayer he would be. Our official rate of interest, 2.5% per annum. Right. Now the average method, the average method, doing like we did before, it would be, what was the loan outstanding at the start of the year? 35,000. Plus, what is the loan outstanding at the end of the year? The remaining 15,000, 15. Divide by 2 gives us our average loan. 35 plus 15 is 50, divided by 2 is 25,000. Times, what is our official rate of interest? 2.5%. And we would work that as the assessable benefit. You can do that. You've got a calculator there. Less, and this unfortunately is where it gets more awkward, any interest paid. My example before, up here, looking at these figures there, there was interest free. So you just had to use the 2.5% as we have done there. But where there's interest paid and there are, again, repayments that are made during the year, then you've got yourself a bit of a slog here, I'm afraid. You've got to work out what those interest payments would be. So at the start of the year, the loan outstanding on me was 35,000, and on which the individual would be paying 1%. For how many months? When was the first repayment? 1st of June 17. So the tax year started at the beginning, well, 6th of April 17. So we've got April, May, 2 months. Then the loan level dropped. So for 2 months, the loan outstanding was £35,000. We then repaid £5,000. That brought the loan level down to £30,000 at 1%. For how many months? That was from the 1st of June 17 through to the 1st of December 17. So June, July, August, September, October, November there through to the 1st December. That, methinks, is 6 months. And again, you'd put all these numbers through your calculator and work out the amount of interest paid, all of which would be deducted from this basic assessable benefit here. The loan then went down to £15,000 times 1%, and that would have been outstanding then for the remaining 4 months. You deduct that. Right. Before we go any further and complicate it any more, can you work those numbers through and then please check that out with the answer in the back to make sure that we're happy with our determination of the assessable benefit using the average method. So pause at this point while you do that, then go to the answer in the back and check that out, please. Okay, well, hopefully you found the results of the calculations that we showed there on that question page. We've done our average method. There's our £35,000 there, plus 15 divided by 2, the average loan at 2.5%. Well, that apparently comes out to 625. The interest paid calculation that we showed the basis of, coming to 258, that is deducted. So using the average method, the assessable benefit there would be £367. Now, the accurate method, that would be available either for the employee or the HMRC to adopt there. It's a little safeguard for HMRC. That's why we have it there, even though either may adopt it. But it's a safeguard for HMRC in particular. If we didn't have that, then all that might happen is if you had this loan of £35,000 outstanding at the start of the tax year, you might get through to, say, the end of March of that, so basically the full 12 months are up, bar a few days, and then be able to arrange separate external finance for a short period of £35,000, and you repay the £35,000 loan back to the company, back to the employer. So at the end of the tax year, the balance outstanding is nil. So using the average method, it would be 35,000 plus nil divided by 2 times 2.5%, which of course would drive down still further the assessable benefit. And then what would you do? You get to the 6th of April, the start of the tax year, you take the loan out from the company again of 35,000 and pay back the short-term loan that you'd taken there for just a few days, and you've got your loan again. And in that way, you'd be able to restrict what the assessable benefit would be. Obviously, in conjunction, of course, there with the employer. Now, you might say, well, the employer wouldn't do it. Yeah, I know, for most people. But there's an awful lot of owner-managed companies out there, and the owner-manager, he or she being the owner and the manager of the company, would be perfectly happy to make that arrangement in order to reduce the owner-manager's own personal tax cost. So HMRC have it there to stop this accurate method to stop that game being played. Because if you tried that, what you would have is the situation where the revenue would say, Her Majesty's Revenue and Customs there would say that, okay, on the accurate method, we have got 360 days of the tax year where the loan outstanding is £35,000, taken at 2.5%. And for 5 days of the year, the loan outstanding is 0, and therefore there is no benefit. But for the vast majority of the tax year, effectively all 12 months, bar 5 days there, it's going to be 35,000 that would be outstanding. And in that way, you'd effectively get the full assessable benefit. You couldn't escape it by using the average method, because in those circumstances, most definitely HMRC would opt for the accurate method to apply. But a situation like this, where there's just a couple of payments, different times, one early, one late in the tax year, where probably the difference is very great, they might leave it. That said, most employees of separate and independent employers, not owner managers of their own company, then for those employees, they're probably paying back monthly, and you would only ever use the average method. But here, the accurate method, what was it? As we have seen working the interest paid, we had got there some 2 months, 6 months and 4 months at the different loan levels. So repeating that here, 2 months, 6 months, 4 months at the different loan levels at 2.5%. It increases the overall assessment from 625 to 646. It's still less the same deduction, 258 for the interest actually paid on those loans. That hasn't changed, it's still £258, but that pushes up the benefit to 388 from 367. HMRC therefore would be entitled to opt for the accurate basis, as this gives a higher assessment. Whether they bother or not, that's a separate matter. If you're asked, however, in a question to work out what the assessment would be, there it is, 388, on the presumption indeed that HMRC would exercise that option for the accurate method to apply. Good. Now then, that simply leaves at the end of this chapter, not something for you to read now, to be honest, it's something with the other administration issues to be looked at closer to exam date, because it's rather more a sit down and learn it rather than a sit down, work through and practice it. It's an understanding thing, most of the computational stuff. The admin is just a learning exercise. So I'd suggest that that private study is done not immediately now, but closer to exam date. Better if you're working methodically through these chapters to move on to and deal with the other computational issues of the various taxes still to be done there, and come back to the administrative areas over the last period when you're revising the other stuff. You can quickly then add in those admin issues. But you've got to have a good solid understanding of each of the taxes, I'd suggest, before spending time looking at the admin sections. Okay, in which case that sorts out now all of the income issues pertaining to the income tax computation. We've seen all of the various different types of income, from the different types of investment income, whether it was interest income, property income or dividend income, and we've seen then the areas of earned income that dwarf the areas of investment income in terms of the amount of work that you need to do. Some 5 chapters given over to dealing with trading income assessments of unincorporated traders. Just 1 chapter here for employment, albeit a pretty big chapter there. Within this chapter, we have made mention again of pension contributions, as we had made mention of pension contributions back in chapter 2. Back in chapter 2, it was all about personal pension contributions and what they did, the extension of the basic rate band limit and the higher rate band limit. In this particular section, we have also come across occupational pension scheme contributions, where whatever is paid by the employer is an exempt benefit, and whatever is paid by the employee is an allowable deduction against your employment income. Remind yourself of that before we move then next to chapter 10, where we look in more detail at the different pension schemes, personal and occupational, at the contributions made into them by employee and potentially by employer, or of course in relation to personal, that brings back into play the self-employed. A self-employed person has no employer to set up a pension fund and make contributions into it on their behalf. All they have is a personal pension contribution. If they don't look after themselves, nobody else is going to do it for them. They have to make their own provision and make a personal pension contribution. Well, we'll be looking at that area of tax relief in relation to pension contributions in more detail in chapter 10. That awaits us, therefore, in our next chapter.